Imagine a tech giant preparing to swallow a competitor for $10 billion. The CEO walks into the boardroom, and the directors all have the same question. How do we know this is actually worth the price? That question highlights the central problem in high finance. While a company can measure every cent it spends today, it has to project those returns into a future where interest rates shift, consumer habits change, and new competitors emerge overnight. Whether a developer is breaking ground on a new skyscraper, a venture capitalist is valuing a 2-year-old Silicon Valley startup, or a private equity firm is executing a corporate buyout, the stakes are staggering. To navigate that risk, the industry relies on a specific tool, the financial model. It translates a massive, complex business problem into a structured, mathematical format. When hundreds of millions of dollars are on the line, a CEO can't rely on a gut feeling. They need a logical, defensible map of the future to prove exactly why a deal makes sense. Building a financial model is like engineering an intricate machine from the ground up, and it requires two entirely distinct layers to function. The first layer is the science. We take 3 to 5 years of historical data, revenue, expenses, cash flows, and lay down an objective, testable foundation of how the company actually performs. This chart shows the company's past performance solidifying into a single line, but then breaking apart into multiple possible futures. This transition represents the art of modeling. Because the future hasn't happened yet, an analyst uses their judgment to decide which of these dotted lines is most likely. There is a universal law in modeling: garbage in, garbage out. Typing in a massive growth rate without a solid reason immediately corrupts the entire machine. The math might be perfect, but the final output is a total fantasy. This is why an analyst needs deep qualitative context. Two people can look at the very same spreadsheet, but the one who understands the market, the product's life cycle, and the broader economy will build the more realistic assumption. To handle billions safely, spreadsheets follow strict engineering standards, isolating inputs, calculations, and outputs into distinct sections. Analysts also rely on universal color coding. Blue indicates a hard-coded manual assumption. Black means a formula. Green links to external sources, and red is a critical warning flag. But the most dangerous sin you can commit is hard-coding numbers directly inside a formula. If an analyst buries a static number, like a 15% tax rate, inside a calculation, tracking down errors becomes impossible, and the model breaks apart. These strict structural rules guarantee the math can be easily audited. That transparency separates a reliable corporate tool from a disastrous spreadsheet that could bankrupt a firm. Once the core engine, which forecasts the income statement, balance sheet, and cash flow, is fully built, we can instantly adapt it for specific corporate goals. If the goal is to figure out what a company's shares are actually worth, we use a discounted cash flow, or DCF model, to calculate its intrinsic valuation. Or if a private equity firm wants to buy a company, they build a leveraged buyout, or LBO model. They use a small amount of their own equity and rely on massive amounts of borrowed debt to lift and acquire the much larger target company. Whether they are acquiring a multinational competitor or launching a new product line, the underlying mechanics of tracking cash flow remain completely identical across the board. Even after the math is perfected, the model isn't finished. Because the future is uncertain, every assumption has to be subjected to a stress test known as scenario analysis. We intentionally shift the variables to see what happens. We ask, what if revenue growth is only 8% instead of 10%? By toggling between a base case, a best case, and a worst case, we watch how the final valuation reacts to those minor shocks. Calculating that worst-case scenario is crucial. It provides executives with a baseline safety net, ensuring they can still survive the transaction even if the market turns against them. There is a central irony to this entire industry. There is no such thing as a 100% correct financial model, simply because nobody can guarantee the future. A financial model provides the conviction to act. By breaking down variables into transparent, tested math, it allows leaders to quantify their risks and move forward with billions of dollars in capital.